There is a number that sits beneath every house price in Britain. It is not the asking price. It is not the land registry figure. It is not the stamp duty, or the surveyor's valuation, or the estate agent's optimistic estimate. The number is 4.5. 4.5 is the income multiple that a bank will lend you to buy a house. 4.5 times your annual salary. That is, in the United Kingdom today, the ceiling through which most first-time buyers cannot pass. You can earn £100,000 a year and still be unable to afford a home in most of London, because the bank will lend you £450,000, and there is nothing decent in central London for £450,000. You can earn £50,000 a year and find that the house you want, the house that is a 20-minute commute from your job, in a reasonable state of repair with enough rooms for your family, costs £400,000. You can save for 15 years. You can inherit something from a grandparent, or you cannot buy. This ceiling was set by the Bank of England, not by the market, not by some invisible force of supply and demand, by a specific committee sitting in a building on Threadneedle Street making a specific policy decision that has had the effect of determining what millions of British people are able to afford, in what part of the country they are able to live, and what quality of life they are able to have. And 4.5 is just the most visible part of the mechanism. The mortgage market in the United Kingdom is, in ways that most borrowers do not fully appreciate, one of the most concentrated and tightly controlled credit markets in any developed economy. 6 banks control roughly 70% of all mortgage lending. Those 6 banks compete with each other, but only within the framework set by the Bank of England, the Prudential Regulation Authority, and the Financial Conduct Authority. The parameters of that framework, how much you can borrow, at what interest rate, against what security, over what term, determine more than almost any other single factor what houses cost. When banks lend more freely, prices rise to absorb the available credit. When banks tighten, prices fall or stagnate. When the Bank of England cuts interest rates, mortgage payments fall, buyers flood back into the market, and house prices rise. When it raises rates, the reverse happens. This is not a controversial claim. Every mainstream economist, every estate agent, every mortgage broker in Britain understands this relationship. It is axiomatic. What is less often discussed is the way this mechanism has been used, explicitly and deliberately, to support house prices rather than constrain them. The way successive governments have designed schemes, Help to Buy being the most recent and most egregious example, that pumped public money directly into the mortgage market to keep prices up. The way the buy-to-let mortgage market was created and expanded through explicit regulatory choices, not market evolution. And the way the 6 banks that dominate mortgage lending are not neutral intermediaries, but actors with their own interests in the shape of the market they control. Over the next 60 minutes, we are going to follow the trail that leads from the Bank of England to your rent payment, because that trail is shorter and more direct than you might think. This is the paper trail, and this is how UK banks control housing. To understand how banks control housing, you first need to understand how the mortgage market actually works, because it does not work the way most borrowers assume. When you apply for a mortgage, you probably think of the bank as lending you money it holds in reserve, money deposited by savers, pooled together, then lent to borrowers. That is, broadly, not how it works. When a bank makes a mortgage loan, it creates the money it lends. Not metaphorically, literally. The bank enters a number into your account, and that number represents a claim on the real economy. A claim backed not by pre-existing deposits, but by the value of the property you have pledged as collateral, combined with the bank's confidence in your ability to repay. The Bank of England has published plain language explanations of this process. Money is created by commercial banks when they lend. The deposits in the system increase at the same time as the lending. Lending creates deposits, not the other way around. This matters enormously for housing because it means that the supply of mortgage credit is not, in any meaningful sense, constrained by how much money has been saved. It is constrained by how much risk the bank is willing to take on, regulated by the authorities that oversee the bank, and limited by the bank's own capital requirements. When those constraints are loose, credit flows freely and prices rise. When they are tight, the reverse. Between the mid-1980s and 2008, the constraints were progressively loosened. In the UK, as in the United States and much of Europe, the financial deregulation of the Thatcher-era open mortgage lending to new entrants, new products, and new levels of risk. Mortgage income multiples, which had historically been around 2 to 2.5 times annual income, rose through the 1990s to 3, then 4, then above. Self-certification mortgages, in which borrowers declared their own income without verification, became widespread. Interest-only mortgages, which required no capital repayment during the loan term, expanded the pool of buyers who could service a given loan, and therefore expanded the pool of bidders for every property. Every expansion of credit, by increasing the pool of buyers and the amount each could bid, pushed house prices higher. This is a direct mechanical relationship. If 100 people are bidding for a house and each can borrow up to 3 times income, the house will sell for roughly 3 times the median bidder's income. If lending multiples rise to 5 times income, the same house with the same 100 bidders will sell for 5 times the median income. The house has not changed. The land beneath it has not changed. The neighborhood has not changed. Only the credit conditions have. This is the single most important fact about the relationship between banks and housing, and it is almost never the headline of any housing policy debate. Politicians debate planning permissions and green belts and immigration. They do not, as a rule, stand up in the Commons and say, "House prices rose because the banks were allowed to lend more money per pound of income every year for 3 decades. In 2008, the credit machine broke. Banks had lent too much against too little real value. The global financial crisis forced a reckoning with both the levels of debt and the regulatory framework that had allowed it to accumulate. In the UK, the Bank of England was restructured. The Prudential Regulation Authority was given oversight of systemic risk in the banking sector. New rules were introduced about how much lenders could lend relative to a borrower's income. The key rule, introduced in 2014, was the loan-to-income flow limit. Under this rule, no lender could make more than 15% of its new residential mortgages at an income multiple of 4.5 or above. The 4.5 limit was not a hard ceiling on individual mortgages. Banks could and did lend above 4.5 in individual cases, but they could not do it in bulk. The purpose of the limit was to prevent the kind of systemic overlending that had characterized the pre-2008 period. That rule was in place, essentially unchanged, for a decade. Its effects on the housing market were real but limited because the cap applied to the share of loans, not to the price of houses. If prices were already inflated relative to incomes, which they were by 2014 after 3 decades of credit expansion, then a rule preventing further multiple inflation did not make houses cheaper. It simply prevented them from getting relatively more expensive for borrowers at the margin of affordability. Then, in July 2025, the Bank of England's Financial Policy Committee announced a relaxation of the limit. Under the new rules, individual banks were no longer bound by the 15% firm level cap, provided the market-wide aggregate remained consistent with 15%. In practice, this meant that larger banks with smaller shares of high-multiple lending could expand their high-multiple books significantly. Several major lenders responded almost immediately by raising their maximum lending multiples for first-time buyers. As of early 2026, the Bank of England was consulting on removing the individual firm-level cap entirely. Was this a good thing or a bad thing? The banks and the government argued that it was good for first-time buyers, who would now be able to borrow more and access the market. The critics argued that it was a gift to house sellers, because more credit chasing the same supply of houses would push prices up. This debate was, in some ways, the entire housing policy debate in miniature. Ease credit conditions and buyers can access the market, but the market absorbs the new credit and prices rise, leaving next year's buyers no better off. The only beneficiaries of looser credit in a supply-constrained market are the people who already own houses. Their assets become worth more. The banks who hold that collateral are not neutral in this debate. The UK mortgage market is, by international standards, highly concentrated. 6 institutions, Lloyds Banking Group, NatWest Nationwide Building Society, Santander UK, Barclays, and HSBC, together account for roughly 72% of all gross mortgage lending in the country. Lloyds alone holds approximately 17% of the market, with almost £310 billion of outstanding mortgage balances on its books. This concentration matters for several reasons. The first is pricing. In a competitive market with many lenders, interest rates on mortgages would be pressed toward the cost of funds. In a market dominated by 6 large players, pricing is more oligopolistic. Banks do compete on headline rates, particularly for remortgage business, and there are dozens of smaller lenders and challenger banks who create some pressure at the margins. But the Big Six dominance means that they can maintain net interest margins, the spread between what they pay depositors and what they charge borrowers, that are substantially wider than you would expect in a more fragmented market. These margins are not huge in percentage terms, but on a total mortgage book of £1.7 trillion, even a small improvement in net interest margin represents billions in annual profit. The second reason concentration matters is risk. Because 6 large institutions account for most of mortgage lending, the decisions made by those 6 institutions collectively determine what the housing market can and cannot do. If all 6 tighten lending criteria simultaneously, the housing market freezes. If all 6 loosen them simultaneously, prices surge. And because all 6 are subject to the same regulatory framework, overseen by the same bodies, responding to the same monetary policy signals from the same central bank, they tend to move broadly together. The housing market in the UK is, to a remarkable degree, driven by the collective credit decisions of a small number of very large institutions, all dancing to the same regulatory music. The third reason is the nature of the asset class itself. Banks do not merely profit from making mortgage loans. They need mortgages. Residential mortgages are, by regulatory definition under the Basel Capital Adequacy Framework, among the least capital-intensive assets a bank can hold. The risk weighting applied to a standard residential mortgage, typically 25 to 35% for a standard loan-to-value ratio, means that a bank needs to hold far less capital against a residential mortgage than against, say, a corporate loan or an unsecured personal credit. This makes residential mortgage lending structurally attractive to banks. They can deploy more money per pound of equity capital. The returns on equity are higher. The fourth reason concentration matters is what banks do with it politically. Lloyds, NatWest, Barclays, HSBC, Nationwide, and Santander are, together, among the most significant lobbying forces in British economic policy. They employ thousands of government relations professionals, fund think tanks that produce housing policy papers, and have access to senior government officials that would be the envy of most industries. The positions they take on housing policy, on mortgage income multiples, on affordability rules, on the structure of the buy-to-let market, on help to buy, are not publicly declared as advocacy for their own interests. They are dressed in the language of economic necessity, market efficiency, and the interests of first-time buyers. The effect is real, however. Every major change in UK mortgage regulation over the past 30 years has been preceded by extensive consultation with the major lenders. The outcomes of those consultations tend to reflect, with some precision, what the major lenders wanted. The 2014 loan-to-income rules came from the Bank of England rather than from government. But the level at which the limit was set, 4.5 rather than 3 or 4, reflects a calibration of what the banks could live with. The 2025 relaxation of those rules came after sustained industry pressure for exactly that relaxation. The specific structure of Help to Buy, which we will discuss in the next section, was designed to be maximally useful to the major lenders. It guaranteed the top tranche of the mortgage, reducing the bank's risk, while allowing it to continue lending at the same high loan-to-value ratios. None of this is, strictly speaking, corrupt. It is lobbying. It is influence. It is the normal functioning of a system in which the regulated parties have disproportionate access to the regulatory process. But the consequences for the housing market are profound. When the bank's interests align with keeping house prices high, and they do, because high house prices mean high collateral values, which mean lower credit risk and stronger balance sheets, the regulatory environment tends to produce outcomes that keep house prices high. When the bank's interests are indeterminate, when the technical question is purely about how to allocate credit, the regulatory outcome reflects whatever the major lenders can agree on. And when the bank's interests could actually be damaged by a policy, say a policy that sharply reduced house prices, reducing the value of their collateral and forced write-downs on their mortgage books, the policy tends not to happen. This is not a conspiracy. It is the structure. And understanding the structure helps explain why, despite decades of housing policy debate, despite manifesto promises from every major political party, despite the obvious social harm caused by unaffordable housing, the fundamental dynamics of the UK housing market have barely changed. The banks are not the only explanation, but they are a large part of it, and they are almost never named. In March 2013, the then-Chancellor of the Exchequer, George Osborne, announced a scheme that would come to define the political economy of UK housing for the following decade. Help to Buy was presented to the public as a scheme to help ordinary people onto the housing ladder. Under its equity loan component, the most widely used version, the government would lend up to 20% of the purchase price of a new-build home, interest-free for the first 5 years. A buyer would put down a 5% deposit. The government would provide 20%. The bank would provide the remaining 75% as a mortgage. In London, where prices were higher, the government loan was extended to 40%. The scheme was designed with a specific market in mind: new-build houses and flats from volume house builders. Only homes built by registered developers were eligible. The maximum purchase prices were capped but set high enough to accommodate almost everything that the major house builders were building. In London, the cap was £600,000. In the rest of England, it ranged from £186,000 in the northeast to £349,000 in the southwest. Help to Buy ran in various iterations from 2013 to 2023, when the equity loan scheme finally closed to new applicants. During that decade, it was used to complete more than 350,000 property transactions. The government's equity loan exposure, by the end of the scheme, amounted to many billions of pounds. Who benefited? The stated beneficiary was the first-time buyer. And, to be fair, many individuals did use the scheme to access homes they could not otherwise have afforded, and some of those transactions worked out well for them. But the academic evidence on who benefited from Help to Buy is, in aggregate, uncomfortable reading for its architects. Research by the Institute for Fiscal Studies found that higher-income buyers were disproportionate beneficiaries of the scheme because the constraint most buyers face is the loan-to-income cap, how much the bank will lend relative to earnings, rather than the deposit constraint that Help to Buy addressed. For buyers already at the income multiple ceiling, the government's equity loan simply substituted for savings, not for unaffordable borrowing. It freed up deposit savings, not borrowing capacity. And because those buyers' income multiple constraint was unchanged, the scheme did not meaningfully expand the population of people who could afford to buy. The International Monetary Fund, the Bank of England, and multiple academic studies produced evidence that Help to Buy inflated the prices of new-build properties. When the government guarantees part of the mortgage and provides an equity loan, the effective demand for new-build homes rises. When demand rises without a corresponding increase in supply, and the supply of new-build homes is controlled by the same handful of house builders who are the scheme's natural beneficiaries, the price rises to absorb the new demand. In simple terms, Help to Buy subsidized buyers, but much of the subsidy ended up in the seller's pocket. The sellers, in this case, were the volume house builders. Barratt, Persimmon, and Taylor Wimpey, the big three of British house building, were already generating what academic researchers called supernormal profits. Research published in peer-reviewed journals analyzed their investor calls and annual reports from 2007 to 2021 and found that all three companies were openly describing to their shareholders strategies of withholding supply, renegotiating obligations to local authorities, and leveraging their dominant position in the land market to keep input costs low. Their profit margins during the Help to Buy years ran between 17% and 32% annually. In investor calls, their executives used language about their land banking strategy that made clear they understood that they controlled the rate at which housing was built. They were not passive suppliers responding to demand. They were strategic actors calibrating output to maintain price levels that supported their margins. Help to Buy, in this context, was not a housing supply scheme. It was a demand subsidy that flowed directly to an oligopolistic supplier sector operating with explicit profit margins of 17% to 32%. The government spent billions of pounds of public money. The house builders took a significant share of it. And the housing affordability problem, the problem the scheme was nominally designed to address, remained essentially unchanged. Then there is the legacy of the scheme for the buyers who did use it. When a buyer uses Help to Buy, they take on an equity loan, a government stake in their home's value. This loan is interest-free for 5 years. From year 6, interest is charged at 1.75%, rising annually by inflation plus 1%. As house prices rise, the absolute value of the equity loan rises too, because it is calculated as a percentage of the property's current market value, not the original purchase price. Buyers who saw their property values rise substantially also saw their government loan obligation rise. And here is the specific trap. The scheme only applied to new-build homes. New-build homes, particularly flats, have a well-documented tendency to sell at a new-build premium, typically 10 to 20% above equivalent second-hand properties. When a help-to-buy buyer comes to sell or remortgage, they are selling or refinancing a property whose value has often reverted toward the second-hand market price. The new-build premium that was baked into the original purchase price has evaporated. In some London markets, where new-build flat prices have fallen in real terms over the past decade, help-to-buy buyers have found themselves in negative equity, with outstanding government loans that exceed the current market value of their property. The scheme closed in 2023. Its architects pointed to 350,000 completions as evidence of success. Its critics pointed to inflated housebuilder margins, marginal improvements in affordability, and a cohort of buyers now in financial difficulty as evidence of something different. The banks, meanwhile, faced almost none of the risk. Their 75% loan-to-value mortgages were backed by the government's equity loan as a junior tranche, reducing their exposure in the event of default. Help to Buy was, from the bank's perspective, close to the ideal mortgage product. High volumes, lower risk, government guarantee, standard pricing. In 1996, a group of lenders and representatives from the Association of Residential Letting Agents gathered to discuss a specific problem. Residential property investors, the kind of people who wanted to buy a house and rent it out to tenants, had almost no access to formal mortgage credit. The products available to ordinary owner-occupier buyers were not suitable for investment purposes. The rents from the property were not counted as income in affordability calculations. The market, in other words, had not yet been shaped to serve this class of buyer. The group decided to shape it. Within a year, what we now call the buy-to-let mortgage had been invented, a purpose-built product allowing buyers to purchase residential property using mortgage finance calibrated specifically to investment use. Rental income, rather than the borrower's personal income, was the primary affordability metric. Down payments were higher than for residential mortgages, typically 25%. Interest rates were higher, but for the first time, a middle-class investor with some savings and decent credit could easily finance the purchase of a residential investment property. The effects were transformative. Buy-to-let mortgages barely existed in 1996. By 2007, there were over 1 million of them outstanding. By 2025, the number of fixed-rate buy-to-let mortgages outstanding in the UK stood at 1.44 million. Total outstanding buy-to-let mortgage balances were in the hundreds of billions of pounds. And crucially, the nature of who was using those mortgages had also shifted. In the scheme's early years, most buy-to-let borrowers were small landlords with 1 or 2 properties. By 2025, portfolio landlords, those with 4 or more mortgage properties, had become a dominant force, and an accelerating share of buy-to-let purchases were being made through limited company structures. A record 66,500 new buy-to-let companies were formed in 2025 alone. By that year, 43% of all new buy-to-let mortgage purchases were going through limited companies, up from just 7.5% in 2018. The shift to limited companies was itself a direct consequence of government policy. In 2015, the then-Chancellor George Osborne announced that mortgage interest relief, the tax break that allowed landlords to offset their mortgage interest against their rental income, would be restricted and then eliminated for individually held properties. For a landlord with a highly geared portfolio, this was financially devastating. Suddenly, landlords were being taxed on rental income gross of their financing costs, even though those costs were a real economic expense. The logical response was to move properties into a limited company structure in which interest remained fully deductible as a legitimate business cost. Osborne's stated intention was to cool the buy-to-let market and level the playing field between investor buyers and owner-occupiers. What actually happened was different. Small landlords, who had been paying income tax on their rental profits, were hit hard, and many sold up. Portfolio landlords with accountants and lawyers quickly restructured through companies and avoided most of the impact. And the mortgage market, responding to demand, developed a rich ecosystem of limited company buy-to-let products. The tax change intended to reduce institutional advantage in the housing market ended up, perversely, favoring sophisticated portfolio landlords over small ones. Now consider what the growth of buy-to-let has done to the housing market at the macro level. When a buy-to-let investor and a first-time buyer are bidding for the same property, they are not bidding on equal terms. The investor has a higher down payment, typically 25% versus 5% for a first-time buyer, which allows him to credibly signal serious intent. In a rising market, he expects to receive both rental income and capital appreciation. His financing costs are, in a limited company structure, tax deductible. And crucially, he is not competing against a ceiling set by his own income multiple. His borrowing capacity is set by the rent the property can generate, not by what he earns. In a market where house prices have risen substantially faster than earnings, this distinction is decisive. The investor can bid up to whatever the rental yield justifies, while the first-time buyer is capped at 4.5 times income. The buy-to-let mortgage was not inevitable. It was invented by lenders with the support of the industry bodies that represent them, because it expanded the addressable market for mortgage lending. A property previously sold to one owner-occupier could now also be sold to an investor who would then rent it back, potentially to the same sort of person who might otherwise have bought it. From the bank's perspective, this was an excellent outcome. One property, multiple loan opportunities over its life cycle. Rental income producing ongoing mortgage repayments. Refinancing every few years generating new arrangement fees and product revenue. The social consequences were different. Every property bought by an investor is a property not bought by an owner-occupier. In aggregate, the growth of buy-to-let transferred a substantial share of the housing stock from owner-occupier to landlord tenure. Home ownership rates in England fell from nearly 71% in 2003 to around 63% by 2024. The decline was sharpest among people aged 25 to 34, where home ownership fell by over 20 percentage points over the same period. The cohort that grew up expecting to own a home in their late 20s now overwhelmingly rents instead. And the people who own the homes they rent in are, increasingly, not individuals who happen to invest. They are sophisticated portfolio operators, running large geared structures through limited companies, with professional advisors and access to mortgage products designed specifically for their use case. The invention of the buy-to-let mortgage, in other words, did not merely expand access to investment property. It helped build a new landlord class, with structural advantages over ordinary buyers that compound with every year the market operates. The banks created this market. The banks profit from it. And the banks are not going to voluntarily close it. Between June 2003 and September 2022, a period of almost exactly 19 years, the Bank of England base rate never exceeded 6%. For most of that period, between 2009 and 2021, it sat at or below 0.5%. For a sustained stretch in 2020, it fell to 0.1%, essentially zero. This mattered to the housing market in a way that almost nothing else did. When money costs almost nothing to borrow, the calculation of whether to invest in real estate changes fundamentally. In a world where your savings earn zero in a bank account, buying a house and renting it out, earning a net yield of 3, 4, or 5%, looks extremely attractive. When your borrowing costs are 1 or 2% and the rent you collect is 3 or 4%, your margin is positive from day one. You have, in other words, been given a mechanism to convert cheap borrowed money into real physical assets that generate a cash return. And when those same cheap borrowing costs flow into the mortgage market, every owner-occupier buyer can also afford to bid more for every property, because their monthly payment on any given loan amount has fallen sharply. More bidders, each able to bid more. The result in a supply-constrained market is unambiguously higher prices. Between 2009 and 2022, UK house prices rose by approximately 80% in nominal terms. They rose by roughly 50% in real terms, adjusted for general inflation. This occurred during a period in which wage growth was historically weak, in which the economy performed poorly, and in which planning permissions for new homes, if anything, became tighter. The factor that drove prices was not economic fundamentals. It was cheap money. The Bank of England was aware of this. In its own publications, the Monetary Policy Committee regularly acknowledged that low interest rates supported asset prices, including house prices. This was, in the central bank's framing, an intended consequence. By supporting asset prices, the bank hoped to generate a wealth effect, to make people who owned assets feel wealthier, and therefore more confident to spend, which would support demand in the broader economy. Whether this strategy was economically sensible is a matter of genuine dispute. Whether it was fair to the people who did not own assets, overwhelmingly younger people and those without family wealth, is less disputable. Then came inflation. In 2022, following the combined effects of the post-pandemic supply chain disruption and the energy price shock following Russia's invasion of Ukraine, inflation in the UK reached levels not seen in 4 decades. The Bank of England, whose mandate is price stability, responded in the only way available to it, by raising interest rates. From December 2021 to August 2023, the base rate rose from 0.1% to 5.25%, the fastest sustained rate rise in a generation. The effect on the mortgage market was immediate and severe. Homeowners who had bought or remortgaged at record low rates found, when their fixed-rate terms expired, that their monthly payments were doubling or tripling. A household that had been paying £900 a month on a tracker mortgage now faced £1,800. A young family that had stretched to buy at the peak of the market in 2021, using a 2-year fix at 2%, found themselves needing to remortgage at 5.5% in 2023, a monthly payment increase of hundreds, sometimes thousands of pounds. Mortgage arrears rose, not to the catastrophic levels of the early 1990s recession, when unemployment combined with mortgage rate rises to produce a wave of repossessions, but enough to be statistically and socially significant. Bank of England data showed that outstanding mortgage balances in arrears stood at £20.6 billion in the third quarter of 2025, even after falling from the peak. As a proportion of total mortgage debt, arrears were over 1%. For renters, the rate cycle brought different hardship. When landlords' mortgage costs rose sharply, many passed the increases to tenants through higher rents or, faced with negative cash flows on their portfolios, sold their properties. The rental market tightened, supply fell, and rents rose. And here is the perverse feedback loop that the rate cycle exposed. When interest rates are low, house prices rise because buyers can afford to borrow more. When interest rates rise, house prices are supposed to fall. That is the mechanism by which higher rates cool the economy. But in the UK, for several reasons, house prices did not fall sharply after 2022. They cooled. They fell modestly in real terms, but the nominal fall was small and, in most of the country, brief. By late 2025, average UK house prices were back to around £270,000, close to their peaks. Why did prices not fall further? Partly because the Bank of England signaled, credibly, that it would start cutting rates once inflation was under control. Buyers who might otherwise have sold distressed properties chose to hold, expecting a recovery. Lenders, facing the possibility of a wave of negative equity if they forced sales at falling prices, extended forbearance generously to borrowers in difficulty. And the supply of homes for sale remained constrained, as it always is in the UK. The result was that higher interest rates translated, primarily, not into lower house prices but into lower transaction volumes and higher monthly costs for both buyers and renters. Those who already owned, and whose fixed rates had not yet expired, were largely insulated. Those who were trying to buy, or whose leases were up for renewal, bore the full brunt of the adjustment. The rate cycle, in other words, reproduced in compressed form the same distributional pattern that has characterized UK housing for 3 decades. Those with existing assets were protected. Those without were exposed. We have now looked at several separate pieces of the mechanism. The loan-to-income ceiling, the Big Six dominance of the mortgage market, Help to Buy, Buy-to-Let, and the effect of the interest rate cycle. Let us step back and look at how these pieces fit together. They fit together as a system, not a planned system, not a conspiracy, but a system nonetheless, in the sense that each piece reinforces the others, and all of them have the same distributional effect. They transfer wealth from people who do not own housing to people who do. Consider how the pieces interact. The Big Six banks' dominance of mortgage lending means that their risk appetite, and their lobbying influence substantially determine the terms on which credit is available. Their dominance is reinforced by the regulatory framework, which requires significant capital and compliance resources that smaller lenders struggle to provide. This concentration means that when the Big Six collectively decide that high loan-to-income lending is good for their business, because it expands volume without materially increasing their risk, at least in the short term, the regulatory framework accommodates that preference. The July 2025 relaxation of the loan-to-income limit was not forced on a reluctant industry. It was enthusiastically welcomed by it. Those same credit conditions determine what prices can be sustained. If the Big Six will lend 4.5 times income, prices converge on 4.5 times income in competitive markets. When that multiple is relaxed, prices absorb the expanded credit, a benefit that flows to existing owners whose assets are now worth more, and to the banks whose collateral has appreciated. Help to Buy layered a direct public subsidy on top of this system, with most of the subsidy captured by the volume house builders rather than buyers. The house builders, who control the supply of new homes, calibrate their output to maintain the price levels at which their margins are maximized. Academic research published in 2023 and 2025 documented this explicitly. Barrett, Persimmon, and Taylor Wimpey were transparent with their shareholders about using supply control to maintain prices. This is entirely legal. It is also entirely contrary to the stated objective of housing policy, which is to increase supply and reduce prices. Buy-to-let added a permanent class of investors competing for the same housing stock as owner-occupiers, financed by mortgage products specifically designed to advantage investment purchases over owner-occupation. The bank's interest in expanding this market is clear. More borrowers, more transactions, more fee income. The social cost, fewer owner-occupiers, higher rents, greater wealth concentration, is borne not by the banks but by the tenants and priced-out buyers who live with the consequences. And the interest rate cycle, which most economists treat as a technical matter of monetary policy, repeatedly interacts with this system in ways that protect asset owners and expose non-owners. Rate cuts inflate asset prices. Rate rises increase borrowing costs and rents. In neither direction does the first-order effect reduce the asset wealth of people who already own houses, at least not durably. The system absorbs the shocks and bounces back. What does this system produce in aggregate? It produces, and this is well documented, one of the highest levels of residential property wealth concentration in the developed world. In the United Kingdom, residential property is the largest asset class in the economy, worth, at current prices, roughly £10 trillion. Approximately 20% of the adult population owns roughly 60% of that wealth. The bottom 50% of the adult population owns almost none of it because the bottom 50% rents or lives in social housing or has not yet been able to purchase. Property wealth is effectively inherited. ONS research shows that parental home ownership is now the single strongest predictor of whether a child will own a home as an adult. Children of homeowners are dramatically more likely to own, partly because they are more likely to receive deposits as gifts or inheritance, and partly because the wealth their parents accumulated through house price appreciation means the family balance sheet can absorb the costs of entry. This is not how a housing market is supposed to work. It is not how competitive markets are supposed to work. In most other asset classes, the prospect of outsized returns attracts new entrants, competition intensifies, returns moderate, and the market normalizes. In UK housing, the barriers to entry, planning restrictions, construction costs, lending constraints, the dominance of established house builders in the land market, are high enough that this normalization has not happened at the scale required to change the overall trajectory. The system reproduces itself, and the banks are central to that reproduction. Not because they are uniquely malevolent, but because they are rational actors operating within a framework that rewards them for doing exactly what they do. Given everything we have described, what could actually change the system? Let us consider the levers one by one. The first lever is credit regulation. The loan-to-income limit is, in principle, a tool that could be used to deflate the house price-to-income ratio rather than merely to prevent it from getting worse. If the loan-to-income limit were reduced from 4.5 to 3.5 in a controlled and signaled way over several years, house prices relative to incomes would fall. This would reduce the size of new mortgages, reduce banks' mortgage books as a share of GDP, and impose pain on existing owners whose equity would decline. It would also make first-time buying radically more accessible for the subsequent generation. No government is currently proposing this because the political consequences of falling house prices are severe. Roughly 63% of English households are owner-occupiers, and many of them depend on their home's value as their primary retirement asset. A policy that deflates house prices is a policy that reduces the retirement wealth of the majority of the electorate. The political arithmetic is unambiguous, but consider the alternative arithmetic. Every year that house prices stay inflated relative to incomes, home ownership rates fall further among people under 40. Every year, the inheritance of housing wealth becomes more decisive as a determinant of life outcomes. The country separates slowly into those who inherited or received gifts and those who did not. The long-term social and political stability of a country in which life prospects are so heavily determined by parental wealth is questionable. The second lever is buy-to-let taxation. A more aggressive approach to the taxation of investment property, higher capital gains tax rates at disposal, annual property taxes calibrated to market value rather than the outdated council tax bans, restrictions on corporate structures, would reduce the return on investment property and slow the transfer of the stock from owner occupation to rented tenure. Several parties have proposed elements of this. None have yet implemented anything approaching the full package. The third lever is Help to Buy and its successors. The original Help to Buy scheme closed in 2023. Various replacement schemes are under development or discussion, including a mortgage guarantee scheme supported by the Labour government. If the design lessons of Help to Buy have been learned, such schemes would be calibrated to expand the supply of housing rather than simply to subsidize demand. Whether they will be is an open question. The house builder lobby remains powerful, and the temptation to create a scheme that generates headlines about first-time buyers while delivering most of its financial value to the suppliers of new homes has not diminished. The fourth lever is public banking and credit direction. In several other countries, public financial institutions play a significant role in directing mortgage credit towards socially beneficial uses. The German KfW Bank, for example, offers heavily subsidized mortgage rates to buyers of energy-efficient homes, new social housing construction, and first-time buyers with lower incomes. The Danish mortgage system, which is separate from the main banking sector, operates on a covered bond model that is structurally different from UK mortgage lending and has historically produced lower costs for borrowers. These models exist. They work. They require political will to establish and sustain. The fifth lever is the Bank of England itself. The bank's Financial Policy Committee, which sets the loan-to-income limit and other systemic risk tools, could be given a broader remit that includes housing affordability as an explicit objective alongside financial stability. Currently, the Financial Policy Committee is not mandated to care whether house prices are affordable for ordinary buyers. It is mandated to care whether the financial system is stable. These objectives are related but not the same. Affordability can deteriorate dramatically while the financial system remains stable. A broader mandate could change the incentive structure. The sixth lever, which we discussed in earlier videos, is supply. If the UK built substantially more housing in the places people want to live, primarily within commuting distance of well-paid work, the supply constraint that allows every unit of additional credit to be immediately absorbed by higher prices would gradually loosen. The Labour government that came to office in 2024 has set ambitious housing supply targets and begun reforming the planning system. Whether it can deliver on those targets is uncertain. The planning system is resistant. NIMBYism is powerful. But the direction is right, and sustained supply expansion is the only intervention that does not require the banks to lend less, house prices to fall, or existing owners to lose wealth. It is, in that sense, the politically least costly option. None of these levers individually is a solution. All of them together, pursued with sustained commitment over a long period, could substantially change the housing market. The institutional barriers are real but not immovable. The political barriers are significant but not permanent. And the demographic pressure, the growing share of the electorate who rent and who see no plausible path to ownership under current conditions, is slowly but measurably shifting the political landscape. Let me close this trilogy with the single most important thing to understand about housing, money, and the institutions that connect them. Housing is not expensive because of impersonal market forces you cannot understand or influence. It is expensive because of decisions, specific, identifiable, reversible decisions made by specific institutions and specific governments in specific years for specific reasons. Those decisions accumulated, they compounded, they created a system, and systems, however entrenched they become, are human constructions. They can be reconstructed. The Bank of England decided in 2014 that 4.5 times income was the right ceiling for most mortgage lending. That was a decision. Could be different. It is being changed in 2025 by another decision. The house builders decided, and this is documented in their own investor communications, to calibrate supply to maintain their margins. That is a decision. Could be subject to different regulation. The banks created the buy-to-let market in 1996. That was a decision. It was not inevitable. Could be at least partially undone. The reason it matters that you understand this is not that you will personally undo it. It is that the false belief that these outcomes are inevitable is itself one of the primary mechanisms by which they are sustained. If you believe that house prices always rise, that banks always set the rules, that governments always fail on housing, then you do not campaign, you do not vote on housing, you do not hold politicians accountable for the specific decisions that produce the specific outcomes we have described over 3 videos. The political geography of housing is changing. In every election in the English-speaking world in recent years, housing has been a more decisive issue than it was in the election before. The coalition of renters, priced-out potential buyers, and parents who cannot help their children into the market is growing. It is becoming old enough to vote in large numbers. It is becoming politically organized in ways it was not a decade ago. The question is whether it becomes organized enough, quickly enough, to produce policies that match the scale of the problem. Let me also be clear about what the banks are and are not. They are not housing's villains. They are profit-seeking institutions operating within rules they did not unilaterally write. They fund housing construction through development lending. They provide mortgage credit without which most people could not buy. The mortgage market, for all its imperfections, has been a mechanism through which tens of millions of ordinary British households have accumulated the most significant asset of their financial lives. That is worth saying. But they are also lobbying to keep the rules that benefit them. They are not neutral participants in the policy debate. They have a material interest in the structure of mortgage lending, in the level of house prices, in the treatment of buy-to-let, and in the design of any government scheme that touches the mortgage market. And they have the resources, access, and sophistication to advance those interests effectively. Understanding that tells you something about where reform will and will not come from. Reform will not come from the banks. It will not come primarily from the house builders. It will come from political pressure expressed through elections and from the regulators who respond to that pressure. Which brings us back, as always, to you. If you own a home, this is not your enemy's story. Your children or your grandchildren or your colleagues or the people who serve your coffee and teach your children and drive your buses are living this story right now. The question is not whether you have a stake in the outcome. The question is which stake you are willing to defend. If you rent and you have made it to the end of this 3rd video, you already understand the shape of the system you are living inside. That understanding is not a small thing. Most people who are priced out of housing in the UK do not know the specific mechanism, the loan-to-income limit, the buy-to-let mortgage, help to buy, the big 6 that produced their situation. You now know it. Knowing the mechanism is the precondition for changing it. This has been the conclusion of the Paper Trails Housing Trilogy. 3 videos, 3 angles on the same question. Why does housing in the UK cost so much and who benefits from that? The rent video, because housing was financialized. The London video, because the city was sold. This video, because the banks were allowed to build and profit from a system that works precisely as designed. Subscribe to the Paper Trail. Share these videos. And if there is a specific part of the system you want us to investigate next, leave a comment. Because there is always more trail. This has been the Paper Trail.